Good morning and welcome to the Monday call. For our first Monday call of 2026, we are reporting back from the closed door Goldman Sachs Global Macro Conference in Hong Kong. Mark James joined me, Stephan, with an on the ground insights and a rear window into global capital flows. From high speed rail and rapid AI adoption to large scale infrastructure and manufacturing, China and Hong Kong are moving at a breathtaking pace. Today we'll explore infrastructure, AI, and markets, and why China may still be misunderstood and underestimated as by global investors. Today's conversation, we will examine why global investors are increasingly paying attention to the region and whether the term emerging markets remains fair given its extraordinary scale and sophistication. Mark James, welcome. Thank
Morning.
you for joining us.
Morning.
Um,
Thank you.
Tell us about the conference. Why is it such an important event?
Shall I kick off with that?
Please.
Look, I think for us, given where we're based, given New Zealand shuts down for the better part of, let's say, 6 weeks, maybe that's a little unfair, but shuts down, whereas many parts of the rest of the world push on, especially in North America and in Asia. It's a good chance for us to sort of come back from a break, re-engage, and importantly get a sense of where the world is. So we've found that typically this conference, their sort of global macro conference, is late in the first week of January. Late in January every year. So it's a good time to just re-engage, get a sense of where consensus is, where people are thinking, and as always, yeah, and we've talked about this many times, market prices are a reflection of where consensus is, where aggregate expectations are. So in some respects, it sort of says, well, this is where the market is thinking on different topics. And that may or may not be right as a result in terms of may or may not be how it plays out because it potentially is already in price.
I think that's a really interesting uh, final point, Mark, because the one of the first or the second, I think, or third time I went there anyway was to this particular conference was uh, late January 2020, and the entire room of there's 3,000 people in the room, and there's a lot of voting, so you have a clicker and they do some general votes around what's the main issues that are going to drive markets, those sorts of things. And if you cast your mind back to January 2020, it was all around tension in the Middle East. I think the US had just fired some rockets or something into Iraq to take out some Iranian very senior generals. And it was all around markets were going to be driven by Middle East and oil and conflict there. And the rest is history because no one ever talked about that again. And it was all around COVID. And so it's wrong. But what that did tell us, though, is despite that tension in the Middle East, the market was very positive. It was very long. It was very pro growth. And so we knew when we did go into COVID where the market was positioned at least. And so we knew that there could be quite violent sell-offs because of that. And so it wasn't like the market was going into COVID really negative anyway. And very defensive. Actually, people were quite aggressive. So it does give you insights perhaps for all the wrong reasons in some ways, but it's certainly an interesting way to put your finger on the pulse of what the market's thinking, which is really important. That consensus view is important.
Well, it's also useful to challenge yourself, right? Is in the sense that you might think your thought process is a little different, or you are looking at something which others aren't, but then you find out actually, no, it's exactly what everybody else is thinking. So you need to challenge your own views as a result.
Probably got a problem then.
Potentially.
Often, yeah. I mean, yeah. Okay. So, and who are the major speakers? And obviously, Goldman Sachs is great at producing these or putting on these major events. How do they attract 3,000 investors from all across the world for this?
Well, look, I think, obviously a lot of Goldman's people speak, as you'd expect. But equally, their headlines are typically major world leaders or ex-world leaders. Um, and, you know, ex-Fed ex-Fed members. I managed to bump into a former director of national intelligence in the lift. Yeah, was on the cabinet, on the Biden cabinet. Essentially, CIA reported to her, so that was kind of interesting. Likewise, James. Yeah, sort of we had the ex-UK Prime
Yeah,
Minister,
we had
right?
Rishi Sunak, who, in of itself, impressive people, don't get me wrong, but also they still are in the corridors of influence. And so while they might not be making decisions, that every day they're talking to people that are, and also just to get their perspective, they know how the plumbing works. And so when they see things happening in real time, they can kind of understand how it fits behind. So there's a lot of talk about from Rishi Sunak around uh, Davos, which is this big billionaire conference that we're not invited to in Switzerland, and he gave some. There was a big controversial speech by Trump, and then an equally controversial speech by Mark Carney from Canada, and he sort of gives insights into how that comes about and the reaction and how the room's set up and all these things. And so those are interesting, less helpful from the investment side, other than to get sentiment around how I guess global leaders are speaking, but thinking, but but probably the more interesting speakers are ones that are less well known, but are ones that are right deep into their area of expertise. So a really really interesting one was he was an author um, from Hong Kong, but spent a lot of time in China, and his book was I'm gonna forget it now. It was Breakneck or something.
Yeah.
Forget the name of it, and we'll post it for those or that are interested. But he just talked about the differences. I caught sort of only half of it, but he talked about the differences between the US and China in terms of just technological development and why China works. And we'll spend a bit of time today talking about that because yeah, it's fascinating around don't underestimate the 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 ability for China to really do well in this sort of AI environment.
That's, I guess, it's one event and one sort of collection of data points for the investment team at NZ Funds. But how do attendees and how do you bring what you learn there into the investment process with building portfolios? Other than obviously you've mentioned expectations and understanding what consensus is there a more structured approach to it, or how do you sort of bring in the learnings from there?
Look, I think that the first and foremost part is that sort of understanding where consensus is and in a degree sort of trying to use it as a way to challenge our thought process and just bring back that sort of sense of where the world is, where expectations are, and how does that compare. A lot of, I suppose, a lot of what we've learned from the likes of Fisher Investments, our external primary external partner, is look back at what's happened in the past and how does that fit with what current expectations are and where are opportunities. So that's really I suppose, the area. It's about sort of what's not being talked about. The focus this time was very much on AI. I think most are, and I think this is correct. People are generally very positive about the global economy, but where the expectations are. I think one thing that came out as being pretty clear and generally, I think is not well understood about last year, maybe outside of the sort of investment community, is that if you think about the pattern of returns last year, there was ultimately a broadening of returns and a move away, a subtle move away from US assets. Markets outside of the US actually did better than the US share market, whilst the US share market did well. At the same time, gold was very strong and dollar was against the majors was weak. So that's a subtle shift out of US assets. And really, that was probably an undercurrent of which came out of the conference. Is many, even though they may not be positive in places like Europe, etc., there is that undercurrent of uh, a move away from US assets. And you touched on China. That's probably potentially one big beneficiary of that.
Yeah, we talked about uh, that phenomenon internally at NZ Funds around markets being claimed as being uninvestable, and and I think we got that about China a couple of years ago. We certainly got that about cryptocurrencies, and uh, there is nothing wrong with having the same positioning as consensus because consensus is often correct, and you don't want to be different for the sake of it. but often where you hear these big claims around markets being uninvestable, that starts, for us at least, starts thing becoming interesting, because that means there's no euphoria, there's very little interest, and there could be some really interesting reasons why that market's actually better than the market thinks. And as I said, we got that in China. We're going to be speaking to the one of the investment committee members from Fisher in a few weeks, and I'm sure we'll talk about Europe and the fact that they've had a big positioning in that Europe trade as well. And remember, during the European economic crisis and banking crisis in 2011, I think it was, Spain was uninvestable. Well,
Greece.
yeah, Greece was uninvestable. Two big strongest markets last year was Spain.
Didn't Spain do something like 60%
Yeah.
last year?
And so it's finding those things out as well. And that's same with China. We've had a position in China. When did you put it on? The team put it on, Mark? Was
Certainly at the beginning of last year,
Yeah.
maybe earlier.
and that's been a strong performer, and but also it's not just because it's not just a property market play in China. There's some really interesting things out of there, and I think it's fair to say at this conference there was some real positivity about China. I mean, China is no longer uninvestable according to the market.
Yeah.
In fact, I think people are banging the table on it.
Yeah, I think probably last time you were at that conference, the poll would have been, is China uninvestable? And there would have been certainly more than 50%. I think this time they did the poll and the number that answered that, where I think it was 4%, said it was uninvestable.
And there's probably someone pressed the wrong button.
So it's obviously being based in now China and Hong Kong.
Yeah, there is a regional tilt to it.
Yeah, there must be, right? But you mentioned earlier that there's a real sense of optimism about the global economy. Were there regions that was more sort of powerful, or was it a general sense across everywhere?
Look, I think, in many respects, and one of the Goldman's economists did sort of comment this, it's kind of the economic setup is very Goldilocks, not too cold, not too hot. You have growth that is about trend in many parts of the world. You do have interest rates have come down again, most parts of the world. So you've got that positive tailwind there. Fiscal, government spending is generally positive. In the US, they have the one big beautiful bill. I think was the bad bill, depending on which way your view is. That was last year, but most of the tax receipts hit about now. People are on a December year end tax return, so they're starting to get those tax receipts. That's about a 0.5% boost to activity, which is pretty meaningful. And then in Europe, you have continuation of that sort of defence spending, etc. So all of that, and then overlaid with some optimism about AI and AI productivity, which we can talk to, really sort of said that the foundations for markets are actually pretty good, and I think that set the underlying tone, or sort of the foundation of a generally positive view, and I think that's right.
What was, I thought, really interesting on that point was there was certainly positivity about share markets globally. And I think that after 3 years of strong growth from the US, there's still there's perhaps reluctance to continue to be positive just because of statistics.
Can't
Say
go on.
you can't go on, but actually, one of the there's a new strategist, head of strategy at Goldman's, who has taken over from someone who's been there a long time, and the new person's name is Ben Schneider, and he made a really good point saying that over the last few years, at least last year, there's two things that makes share markets go up. Earnings stay the same, and this multiples go up. So, i.e., the share market gets more expensive.
More optimistic.
Yeah, more optimistic and expensive but actually, most of the returns from US shares last year was from earnings. So actually, these companies are growing earnings, and that's pushing the share price up, which is which is much more conservative way of thinking about it. And so there is, a potentially a long way to go. That was sort of a really, I thought, good point, and makes us, I guess, optimistic about the year ahead at least. The thing that was talked about a lot, and I thought was slightly different, uh, but Mark delves in these circles far more than me in terms of the debt part of the the economic setup. But there was a lot of concern about government debt and the fact that uh, these governments in developed countries, the US, Europe especially, are spending a lot. Even Germany now is going to have a big budget deficit this year, mostly I think spent on defence, isn't it? And that's kind of unheard of for them. They're normally in budget surplus or there or thereabouts, and so debt levels are getting increased, and the appetite to buy government bonds
Pretty low.
is pretty low because you know, these they want to still charge you a relatively or give you a relatively low interest rate, and they are way more indebted than they were, and so the we've talked about this a lot over the last year, but that 60/40 portfolio is reliant on that investment in really good yielding, safe government bonds. And I'm not suggesting, and Mark could comment on this, but I'm not suggesting these governments are going to default by any means. But people are going to demand a high interest rate. And is there assets out there other than government bonds that we can get that same diversification? And this is why we go on and on about commodities and cryptocurrency and gold and those sorts of things, because you need to diversify away from that what has been perceived as being really safe because of this phenomenon. And the debt levels of some of these countries are not going anywhere. They're going up. Trump's going to spend an extra, was it 15 trillion in this term? And yeah, there's a big chunk of debt there, and that needs to be refinanced.
Yeah.
So yeah, look, I think there was, and probably wasn't. It was more back into the conference, but there was definitely an understanding, I think, that of that base, and that people needed to look wider in terms of their investment options. So certainly gold. The discussions about gold were very much at the fore, especially given us price action that we've seen both up and down. And again, I think there was that sort of very strong view that you need to have an allocation of things like gold instead as a way of sort of providing some diversity in your portfolio, and even more so, stepping into the other commodities that actually become diversifiers at this point, and that bonds potentially, certainly the long end of the curve, so longer maturity bonds are a little more challenged than they've been in yeah the last generation probably.
You might not have this off the top of your head, Mark, so forgive me, but China had owned a certain percentage of US treasuries, and now they own a lot less.
Yeah.
I don't know what the
No,
context is, but
no.
they've certainly used to be the biggest holder of
Yeah.
US debt.
I have a number which this is going to be a topic that I suspect is going to be very top of mind for the next couple of years, and so no doubt this will be the beginning of a longer conversation. But one data point that I read the other day that really stood out to me was, I think it was only 30% of US treasuries are owned by foreign investors. So 70% are, even though their surpluses, their deficit is huge, and their outstanding debt is even huger, it's financed for the most part by American institutions and consumers. So, um, and for some people, that gives them a lot of confidence investing in it. And other people, it doesn't change the dynamic. They, as you say, they're going to demand more. And yeah, okay. So that was a hot topic. What did the sense of the conference in terms of last year's returns? And I see some numbers you've got there, Mark. How did people feel that the US performed compared to other countries?
um Look, I think there was again that undercurrent, as I said, that very much we shouldn't underestimate it. AI is front and center, and from that point AI was everywhere in discussion.
If you did a shot for every time someone mentioned AI, you would have lasted the first 10 minutes of the conference.
So from that point, we shouldn't underplay that, and people are um, very positive AI and sense it as being a real game changer in terms of markets. But I think what was interesting is in terms of performance last year, and I keep slightly broken record, but come back to consensus. There was very much still a theme that, as James said, maybe people are less are not banging the table about the US, but expectations are still high. If we look at sort of current expectations, that's for a US share market to finish this year up about 9%. And what was also interesting is a lot of those expectations are very tightly grouped. There's not many, like almost no bears out there, which is always is a point of uh, hesitation, I suppose. But yeah, from that point, looking for another positive year. If we go to interesting enough, and again, it was possibly a reflection of where we were, but people are not as positive. Europe, broad expectation is up 2% this year, which is not dissimilar to the expectations last year, despite Europe doing much better.
The economist at Goldman's from Europe, in charge of Europe, he looked tired. So
But what I mean, some European countries last year just did like insanely well. I think
Italy and Spain were some of the best performing markets globally. Yeah. So very much from there. To James's earlier point, though, one of the interesting parts about Europe is Europe has been very cheap. A lot of that move last year was more multiple, less about earnings. So they do need to see earnings come through this year. But again, expectations are low. Likewise, in the UK, I think, oddly enough, the expectations in the UK are actually for a small negative return, which is they've got a lot of challenges, but it's a very non-UK share market they have, so potentially quite different. So, but I think, the probably the most interesting thing about the conference, other than what's in the conference, is actually what's happening around and sort of the whole process. And it's probably useful segue for us to go and to sort of say, well, had the opportunity to go into what I call China proper, not just Hong Kong, but into China, and that was that was really useful for us.
what when you say China proper, you mean you physically went over into China and then had a look around?
Yeah, sort of across the border to Shenzhen. Very. Yeah, it's only 30 k's away, so it's not exactly a big trip. But through customs, take the fast train across, 15 minutes on the train, and you're in quite a different world, but one that is very new, very, very developed, and just sort of wakes you up. I think, probably, or reminds you, that's probably the right word, it reminds you of scale, and probably execution, I think. Things just seem to get done there. Is that your.
I couldn't have put it better. I was Hong Kong is much more Western and it's a very forward thinking city, but it's still those Western attributes. You're tripping over the pavement because they haven't properly sealed the road and all that sort of thing. Just like walking down a road in Auckland or London or something, or New York especially. But whoa, I mean that city, it's like it, it's perfect in the sense of it's very very well put together. Uh, there is the infrastructure works. We were the train station where we're in was enormous, and the growth that can I guess come into that city and the infrastructure can cope was quite overwhelming.
So how big is Shenzhen then? Approximately.
It's tiny.
I'm guessing it's I don't know the problem. 15 million, is it? 10 million? Something like that?
Yeah, I think that's the population size of the inner city is about 15, and then was it
Within 100 k's is sort of 50 or 60.
Right. So
yeah.
easy 10x Auckland. And right.
Yeah.
But I think one of the observations that Mark and I are both eager to talk about, I'm sure, is that that everybody talks about China. Everybody, a lot of people talk about China, especially during the Olympics. The concern around the Olympics was pollution, and the other one was traffic. Well, there was a lot of traffic, but it moved and flowed and was very efficient, and
It was all electric.
it was all electric. I think we saw like 2 petrol cars the entire time.
Even the crappy delivery vans that have been beaten up and they're still
The
electric.
crappy scooters that it was, and so there was no pollution. Like we were there on a beautiful bright blue day, and it was beautiful bright and blue, and it was very modern. When we got there, we're still a little bit jet lagged, and so we thought we'd go get a coffee, thinking that's going to be an impossibility. Well, given that we're tourists, we went to a Starbucks because we want to see what a Chinese version of American company is. And for those of you that have had Starbucks in America and New Zealand, this is my personal opinion. It's disgusting. It's really sour because they use a different form of coffee. There's Robusta versus Arabica, and I don't like one of them. I forgot which way round it is. And uh, but China Starbucks must use the one that we use back in New Zealand because the coffee was delicious. The cafe, the Starbucks, was a really nice environment. There was people sitting on couches. We sort of shared a couch with this um, woman who was, really just sort of almost um, welcoming in the sense of like, of course you can sit here with us and just have a chill. And she couldn't speak English, and it was just a really nice, um, positive energy in a American-owned cafe in China. It was cool.
Did you get caramel cream on top?
I think someone got a frappuccino or something like that. I got a flat white because it's like the Big Mac of coffees. I wanted to try it every country. Yeah,
Right.
and it was good.
And types of cars, given that it's all EVs, is it? I assume it's not Teslas for the most part, or is it?
We see a Tesla. There are lots of Teslas in Hong Kong,
Yeah.
but
Tesla.
a lot. Yeah,
That's a strong no, because if you've got 16 million people who drive a lot, no doubt, and you're wondering whether you saw a Tesla,
lots of the names you see here, lots of BYDs, and the different brands, lots we haven't seen before.
Yeah.
I think the biggest uh, electric car, uh, I guess, experience for us was we went to the Huawei, which is a well-known Chinese sort of telecoms infrastructure company, and we went to their shop, which is very like an Apple store, except it's Huawei, and lots of people in there and charging their phones and getting tech assistance and things. But they also do. I didn't actually realize they do electric cars.
So the showroom starts with the phones, moves to laptops, and then moves to something bigger.
And it was a really cool shop, and young energetic people working there and that sort of thing, and all could speak English, and the cars were beautiful. And we got in and sat in, and the fit out internally was just amazing. The technology was, you could open the door without touching the door handle. Like, these cars were top of the line, like you're getting into an Audi or a Mercedes, and they're fully electric and they looked good. And then I think Mark asked, how much do they cost? Was it 60?
The top of the line one with the big SUV with all the bells and whistles was about 100,000 Kiwi.
Yeah.
So
And if you think top of the line with all the bells and whistles, Audi is 250 Kiwi. Where these cars are the stat that always gets me around cars, that I don't know how we square the circle in this industry, is China is 40% of the market in terms of buying German petrol cars, so Audi, Porsche, um, Volkswagen, and those sorts of brands, and 40% of their sales go to China. These same companies have 2% of the Chinese electric car market. And so as the world moves fully electric, these car companies are going to go from a 40% market share in China to almost zero. And you can see why. I mean, it was incredible.
and I think it'll be one interesting that happened last week is the Chinese safety authority has essentially banned electric door handles. I think there's a year's grace or something, but Tesla has an electric door handle, or most of the BYDs have disappearing door handles. They've banned that back to the old-fashioned mechanical ones, and I would expect that will roll out globally across all manufacturers because there's such a demand, so dominant now.
And so stepping up a level, and what can New Zealand learn, and the world, America perhaps, learn from that ability to coordinate and build
Well, I think
infrastructure at such scale, at such pace, and so well coordinated?
just to put some stats around that. In 2008, we caught the high-speed train from Hong Kong to Shenzhen. Unfortunately, it's in a tunnel under the sea, so it goes 150 k's or something, even though it's capable, once it's in China proper, of doing 300. They put their first completed, I think, their first high-speed link between Beijing and Shanghai in 2008. Fast forward today, they now have 50,000 kilometres of high-speed rail links. For that perspective, New Zealand's got about 100,000 kilometres of roads total. So they've got half of our roads are high-speed rail links. Obviously, it's a very big country. Compare and contrast that with the US. They 1965 they had an act, the High Speed Transport Act, was put was put in place. In 2008, the same year as Beijing to Shanghai, California allocated $10 billion to build a high-speed rail link between LA and San Francisco. They might have 10 kilometres built, possibly. The expectations are sometime between 2030 and 2035, it might be completed. I think that's a bit of a story of New Zealand infrastructure as well, especially something like our bridge or tunnel here in Auckland.
Yeah, it's one way that I think is a good way to describe it is the US are very good at inventing things. They might have even invented high-speed rail for all I know. Maybe the South Koreans did. But China is just phenomenal at industrializing it and rolling it out.
I know you mentioned that author. That was a point that he made very clearly is if you look at, especially, going back to that point in 2008, who were the dominant, what was the dominant training of sort of those in the power within the Communist Party, and they were basically all engineers. In America and most of the Western world, the dominant training is as a lawyer, which has a slightly different impact ultimately.
Yeah, I mean, it's ultimately it's the political piece, right? Yeah, what the process is and what the vision is. So, do you feel like what you saw there is going to feed into the rest of the world in terms of they're going to be exporting more and more of what they produce at a higher, I guess up the chain, if you will?
I think at its simplest level, and if we think about, say, global share markets, 70% of the global share market is America. Yep. 3% is China. That's something there seems out of whack.
And yet it's the second biggest economy by GDP in the world.
Yeah. So from that point of view, to not be invested there, you may not have to be massively overweight, but not to be invested there, I think, is a mistake.
And the reason you're not invested is because the index tells you don't have to be, not because it's a small economy or the returns aren't going to be there. Uh, I think that from an economic perspective, not just a markets perspective, to the way I think about your question is it's not just the technology per se, it's the whole integrated system of um, of the infrastructure and the buy-in of the populace. So we went from big stores like the Huawei one I was telling you about to a really neat sort of electronics mall, I guess, of uh, perhaps original and not so original brands, and every single one of them was cashless, and it wasn't paying with a MasterCard or a Visa. It was paying with Alipay or WeChat, and so the whole population is bought into technology, and and so it's sort of it's nothing new around the uptake and use of technology at the consumer level, and then that gets rolled out, all the way up to the infrastructure and the manufacturing and things. But I think most people know this, but China isn't a cheap manufacturing story anymore. It's not a cheap labor place. That's how it perhaps started to urbanize, but it's much more than that. And so for it to continue to be 3% of the share market wouldn't make sense. Of the index, I guess, of the global index.
I guess it ultimately comes down to what percentage of its economy is listed in public markets, and that all no doubt feed into how investable it is and also the willingness to accept capital flows from abroad. So
Yeah, and don't get me wrong. There's lots of reasons why there it is a small part. There's a very dominant government that aren't democratically elected, and you might property rights, I guess, is not looked upon as the same way as property rights are looked upon in New Zealand or the US. Um, and so there's reasons for it. So it's not just, hey, this doesn't make sense, this needs to change, and they've got a lot of work to do to, I guess, get the world to be confident to invest. But it certainly looks like it's heading that way. Or the other way you can look at it is, do they need the rest of the world? They've got a couple of billion people and a government that wants to go from a manufacturing heavy type of economy to a consumer driven economy like the US is, and maybe they don't, need so much outside investment as people believe, but there's still an ability to participate in that market no matter what the rest of the world thinks.
Yeah, that challenge around, I guess, political risk or, uh, you know, country risk premium or however you want to frame it, is an interesting one because even those in China who are investing will be thinking about that too. And um, if you sort of step back on how I think about China, if you look back 20 years, it's moved so far forward up from an investor's perspective, obviously from lots of different perspectives, it might be different, but from an investor's perspective, it's um, some of the major reasons you wouldn't want to invest are lower in their, the, their probability of manifesting or the impact on it. So there are other ones, of course, that geopolitical ones that might be higher now than they previously were, but it certainly feels like it's continuing its developmental journey, if you will. Yeah. Um, Okay, back to the conference for a second. You mentioned how drunk you would be if you had a shot for every AI reference in the first 10 minutes. Where does that? How does AI and China come together, and what does that mean? Um, I guess for investors and the development of that globally.
Do you want to?
Well, I think I just wanted to expand on the question. I don't think that AI was necessarily focused just on China.
Right.
I think that's the important thing. I think anybody anywhere can develop it, and that's part of the amazing thing. I think the winners might not necessarily be out of the US or China, but it's a very broad subject. I think perhaps one of the comment that made headlines wasn't it the CEO of Goldman Sachs saying, "Look, this is." And why it's interesting, not because he's necessarily Goldman Sachs, but how many employees does he have? 100,000 or something like that. And he said, we're not letting people go because of AI, but we might just not hire as many people. And so, and that concern of the unemployment rate and what AI is doing might not be a cliff edge, but it's certainly concerning, I guess, for some industries around what that means in terms of just the hiring rate. But it's also a slower burn. So it means the economy has time to absorb those people that would traditionally go into some roles into others. And so actually the forecast at the conference from Goldman Sachs, this is just Goldman Sachs forecast, there's plenty of other people that will have different views. But their view is that yes, unemployment will go up a little bit, but not all that much because it's a slow, not cliff edge
Transition.
yeah, it's a trend. Thank you. That's the way to describe it. It's a transition rather than a cliff edge, and I think that kind of makes sense. I think if you were there, and there was a couple of really good examples of perhaps where you would be slightly nervous. I think a big one that was talked about is a call center in India, where their economy is really driven by really educated people who are bilingual, but because it's in India, the labor's cheap, able to be offshore to in terms of call centers and things, and you know, and that sort of industry is in real trouble because that's a really good way for these companies to save in costs by using AI. But again, those people are educated and they will be able to be absorbed somewhere, and maybe where they're housed is going to house different types of developers or AI programmers or what have you. So I thought that was interesting. I think
Mm.
you know,
And then the other again theme that had a fair bit of discussion is, that transition we've seen very much focus on infrastructure, the model builders, really the first stage of it. How does that develop in terms of what's the path? Who is the adopter? Where does the productivity come from? Um, it's certainly, and I think again, coming back into that original comment about sort of the Goldilocks type economic environment, you did see with the internet and with TMT cell phones that ultimately in the US there was quite a big productivity boost. And that was one reason why markets did very well at that point, given the speed of adoption of AI and probably its breadth once it rolls out and is adopted more broadly across industry. You can see that sort of pattern coming again, which sort of almost sort of turbocharges economic activity in some areas. So there was a lot of thought about sort of how does it migrate from just the picks and the shovels to start with to actually turning it into use cases.
And at the same time, Mark's talked about this on this podcast before. Uh, it's these are real assets being built, and I think it's forecast 650 billion in the US alone on energy infrastructure. And I think this is all the setup for this isn't these are real assets being built, and it's mainly around data centers, but also energy production. And this is one of the we've been talking about a super cycle in commodities because super cycles last a long time,
Yeah.
10, 15 years. And while this is really going to turbocharge that because the amount of copper, silver, rare earth metals, lithium, platinum, all those types of commodity are really, really going to be in high demand, not for 1 or 2 years, but for many years. And on the supply side of these commodities, um, there's been a massive delay in producing more because of COVID, but also just because of lack of investment. And so I think from an AI perspective, it's really exciting about the hyperscalers and the ones that have been doing really well. Um, the position that Mark and the team have just put in the portfolios around productivity is really exciting. But there's also just the boring old raw materials, which have gone up a lot, but have real supply versus demand squeezes, and have certainly got a long way to go, we think. And it's not going to be a linear line because commodities are inherently volatile, but it's certainly the setup is a good one, and something that we've done a lot of work on over many years, both us and with the help of people like Syzygy and people in Goldman Sachs and some of our other contacts. So that is something that I guess a differentiator is that, or how do you invest in them? Or if you invest in the actual shares of some of these companies, it's funny, Mark, you would love this. I was at the Waitangi weekend. I was at the beach in the weekend, and I was with a guy who met a guy who was a lawyer for one of these copper miners in the UK. He was British, and and he goes, "Yeah, I kind of got out of that industry because as soon as the price goes up, we just really took on debt and just spent." And I was like, "That is why we don't invest in copper miners."
Miners like to dig holes.
Yeah. And they get management team get incentivized to dig holes. Uh, Buying copper, the commodity, is a much cleaner way of doing it, and we can do it because of the people over the years at NZ Funds have developed systems at NZ Funds to be able to do it through buying futures contracts. They're very liquid. They trade almost 24/7, and it's just a really nice way to be able to buy it. And also for risk management, you can easily sell them when you've reached a certain price levels or if there's volatility or something like that.
So just to kind of wind back, so basically, for those of you who aren't, closely connected to investment markets, the idea is if you have the thesis is that say copper is going to go up, that's your investment idea, and there's different ways you can express that idea. You could buy copper miners, but if you do that, you get with it a lot of company specific risks. Are management good? Do their mines have the reserves they might say? Are they producing them at the pace they might want to? And so all of those things you might believe they are really positive, and so it makes sense to buy the share. or you might just want to have, as James says, a clean position of I think copper demand is going to go up and the price is going to, and supply is steady as the broad thesis was, and that's going to translate into price. And so by being able to buy the futures, which is I guess pretty common outside of New Zealand, but it's very common outside of New Zealand, huge common, but within New Zealand and it's not as common in investment portfolios. So and it's a function of, I guess, the way we manage money and the systems and processes we've developed over
Now you could buy it
years.
in an ETF, but they charge you
Fee for it,
1%.
yeah.
And so whereas the fees around futures contracts is negligible.
Okay, fantastic. So, do you think then that I guess winding back from it all, the conference was sort of shifted your thinking, or did it just enhance where you were in your original kind of did you come away from it with this is where we're set, or is it just a new sort of pathways of questions to explore?
Look, I think, from the point of view of economics, as I said, I think I'm in agreement that the Goldilocks setup is really strong. So actually, the base came away probably from the conference more confident about the base of economic activity, which I think sets the framework for this year. But equally, the concentration of views, I think, is something which we've definitely got the view that this year is likely to be positive, but we also need to expect maybe not left of field, but a period where markets' expectations are challenged and they end up being down 10 or 15% at some point this year. And I think the probably the concentration of views did sort of mean that people have the risk of being a little wrong-footed at some point. Yeah, probably a good example. And there isn't much in the way of elections this year. It's a relatively election-free year, but you still have the US midterms. There's definitely a chance for uncertainty, shall we say, out of that. Yeah.
Yeah, there's already been talks of rigged elections, 9 months out or 10 months out. So yeah, that could cause a bit of volatility.
It's funny though, right? If it's Friday and the Dow had such a strong day, and after a couple of not so positive days, and people are. What I took from that was the idea. People are trying to make sense of a really strong economy, but at the same time there is volatility, and people are unsure, and the expectations being moved, um, and now what is it? It's above 50,000, I think, the Dow, which it's for those of you who don't, it's not normally the index everyone looks to, but it's a function of, or it's sort of a snapshot of where the broader US industrial economy is, rather than the S&P 500, which includes a lot of technology stocks and so forth. And if it's really strong, it's a sign that America is as a whole is strong, right? And um, and so I think what I took from that is we're going into a period of uncertainty, but people are really positive, at least in America, even with those technology names having a harder time over recent weeks or months.
And then you've got a really good new Fed governor. Despite all the volatility and volatility in pockets, nominee, sorry. And what the funniest thing about that nominee I learned over the weekend was that despite some of these controversial speeches, controversial in the sense that Mark Carney made quite a controversial speech about going at it alone and away from the US. One of the Fed governor nominee, Walsh's one of his best friends is Mark Carney. So that's going to be a interesting little dynamic as he sits in the office with Trump. But it's all noise. And actually, the most important thing is the predominant assets in the portfolios are shares, and it's around earnings and economic growth.
And do you expect earnings to be positive? And if you do, and
Yeah. And if you have a new productivity driver like AI can be, it can translate to higher margins, which can translate to it's better returns and more investment.
And to muck around trying to forecast what the next GDP number is just a waste of time. Yeah. Actually, what the better use of time is to really take a step back and look at the themes of what's going on in the economy and be attached to those. And it's super exciting. And China was just a little glimpse or Shenzhen at least, was a little
A
glimpse.
3% glimpse, perhaps. Okay, hey, I think we'll leave it there. Thank you, everyone, for joining us. Thank you for joining us, Mark and James, for the first call of 2026. We've got, I think you mentioned, Mike Hansen from Fisher Investments, who is an important person within the Fisher Investment business, and joining us for the next call. And we're looking forward to sharing that with you soon.
Cool.
Have a great week.
Thanks, everyone.
Thanks.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.